Hello and welcome to Fidelity Connect. I'm Glenn Davidson. In today's market environment, contrarian investing isn't for the faint of heart. As the TSX continues to find its footing against the global market backdrop, investors are being challenged to look past the noise and stay focused on what truly creates value. This is where active management earns its keep and where conviction counts most. What if this environment isn't chaos, but instead calibration? And where is our next guest finding optimism amongst it all? Joining me now for a look at how he's navigating today's market environment is Portfolio Manager Hugo Lavallée. Hugo manages several Fidelity funds, including Fidelity Canadian Opportunities Fund and Fidelity Greater Canada Fund. Welcome, Hugo, from Montreal. Wonderful to see you.
Good to see you. How's everything?
Everything's good. And in a portfolio manager's eyes, with optimism, I'm sure you see it as very good as well. You know, Hugo, you and I have spoken many times, and I don't think because you're an active portfolio manager and you're all about stock picking from the bottom up, we've never talked politics. But based on what's just gone on, liberal minority, what are your thoughts on the Canadian landscape right now?
Well, I don't want to disappoint on the Canadian election, but unfortunately, we don't have major takeaways, meaning we did some work ahead of time. We looked at the different parties' agendas, and the Liberal kind of pulled a rug away from the Conservative underneath them and have a very similar agenda. So we don't, there's going to be some puts and takes, but both agendas were to stimulate the economy, and we'll see, maybe do a better job with our resources, but not earth-shattering. And you saw it in the currency market, right? The Canadian market, the Canadian dollar didn't really move. So obviously the most important thing will be to negotiate with President Trump. So hopefully our new Prime Minister is up to that task and can get a good deal for all Canadians. I think that's the most important thing, and that remains to be seen, right? It's a minority, probably going to go back to in elections before the next 4 years. But beyond that, we did some work ahead of time. But compared to if the election would have happened 6 months ago, there was a much bigger difference between the both party lines.
The key is you were doing scenario research prior to the election, and you and the teams look at different outcomes as well, different directions.
Right, and you saw it, right? Like the Canadian dollar didn't really move a bunch of sectors. I think for that part, I think the most important thing will happen at the White House next week, and where do we go from there as a country?
Greater Canada Fund is 53% invested in Canada. Could you tell our viewers your thoughts on Canada overall as a market and just on your positioning right now?
Okay, I guess there's a short term and the long run. So in the long run, I think we tend to undersell ourselves as a truly Canadian fashion. We can truly build some of the best stocks in the world. Constellation Software, Decal, Dollarama, Couche-Tard, and a few others I'm forgetting, but Shopify. We can really do it, and I think that's a reason why to have some Canadian investments. Some people sometimes look at Canada versus ACWI or benchmark weights, and maybe I should own so much Canada. But I think between our resources and our innovation, I think we can always do more, but generally it hasn't been there's definitely been worse markets. And Fidelity's really, really focused on picking the best stocks for the long run. And we can actually, over the last 25 years, some of the best stocks in the world have been in Canada. In the short run, Canada's outperforming the US. But if you look at it, a lot of it's a composition of our benchmark. Right, we have more staples, we have more utilities, we have more gold. Because if you look at Canadian cyclicals, they're not really doing well, right? Until recently, our banks are under pressure. A lot of our cyclicals are under pressure. Canadian cyclicals are under pressure. Construction industry is under pressure. So it's almost like the tales of two halves, or they're not halves, but of two different things happening in Canada. So I'm not interested at this point in chasing the safe stuff. I haven't been adding to gold, and I haven't been adding to utilities. I haven't been adding the last few weeks to staples. If anything, I'm looking at them as sources of funds. And can we buy some of our best Canadian ideas that are kind of down and out. The one risk I'm not willing to take is balance sheet risk. So I'm all for looking at companies that are under earning, but you got to watch the balance sheets. And unfortunately, there's some companies sometimes that have like iffy balance sheets. So that I won't do. But for the rest, we're really trying to find some, and not just in Canada, like globally, our best companies that have been hurt by everything that's happened over the last 60 days.
With Greater Canada Fund, as I was mentioning, 53% is in Canada, but with the remainder of the portfolio, you're able to go anywhere in the world. And you work with the massive Fidelity team around the world. How do you do that?
Well, the simplest way to do it is we read the global research every day, right? And then you can double click on whatever you need to double click. I have about 3% of the fund in Europe, but I'm looking for exceptional companies. I think what you're hearing from a lot of the Fidelity, my counterparts, is trying to get away from the US, more into either Asia or Europe. I guess I'm a little bit different that the pain was really into the United States, right? Russell in the bear market, NASDAQ in the bear market, S&P 500 almost in the bear market, the currency down. And, a lot of the innovations the last 25 years has happened on this side of the pond, right? Canada and the United States. The Googles, the Metas of the world, the Shopifys, they've happened here. So I had brought down my U.S. exposure, but I didn't want to go like super underweight. Like I'm still like, I think Greater Canada is probably roughly 40% U.S. So it's down a little bit from earlier. But, there's no Chipotle in Europe and there's no Cava Group. So that's what I want to be focused on. I'm really focused on companies. I want to focus on our favorite companies. Like if the market's down 20, there's just a ton of stocks that are down 30, 40, 50%. And that's what I want to focus on.
You talked about balance sheet analysis. You meet with companies all the time. Companies are coming to see you. You can dial into meetings. You're going to conferences. You're in front of businesses all the time. It's tougher for them to give guidance now in this environment, isn't it? How do you deal with that?
It's like, it's like impossible. And the truth is, we talk about this all the time. The companies don't know, and sometimes they're too into their business to maybe sometimes see the greater picture. So the one thing we're telling our young analysts, like it's important to talk to companies to understand the facts. And we've had so many of these meetings over the last 3 weeks, and I can give examples. But if sometimes you ask their opinion, it's not going to be better than ours. And sometimes it's a little bit tainted that they're really into their own businesses and they own a lot of their own stocks. So we keep telling our young analysts, like, you got to make up your own mind. And we got to work. In those moments, you're always kind of on your own and you make educated guesses. And, we're talking to our companies, but it's not to get their opinion on anything, because it's really to try to, they'll give guidance, but a lot of them, and you're seeing it during this earnings season, a lot of them are pulling guidances, or they're giving wider ranges, right? So we got to figure out, we got to make our own opinions.
To get those opinions, it's wise to have time in the market. And you started at Fidelity in 2002. You started as an analyst, as all of the portfolio managers at Fidelity really did. Start as an analyst, prove yourself, and become a diversified portfolio manager like yourself. So with time since 2002 with Fidelity, what learnings have taken you to today to deal with this minute-by-minute market volatility that we're seeing?
Okay, so let me give you a longer explanation here on how we deal around, say, Liberation Day, from kind of the experience to the micro. And these are all like real life experiences. So when things get tough, it's always unprecedented. Right, 9/11, weird time to be working finance in a U.S. tower. 2008, it looked like the financial market were going to collapse in November. COVID, at least initially, was really spicy and unprecedented. And now we've got 100 years of tariffs that we're trying to undo in a very short period of time. So when things get unprecedented, I think from the past, what I've learned is maybe the most important thing is, don't panic, and can we see some off-ramps? I think that's really important. And during COVID, that really helped me. That, initially was really bizarre and weird, but pretty quickly you saw, well, the debt rate's 1%. And if you look at Denmark, they're sending people home and they're doing fiscal packages. So I think we're going to be fine. If you see what's happening right now, you have obviously a new administration. They have their agenda. But, there's a few things. Is they're going back in an election in 16 months. So I think they got a very short period of time to kind of execute on their plan. Scott Bessent's been talking a lot about, refinancing the debt at lower rates. So initially, post-Liberation Day, you saw the 10-year rates go up, and I think the bond market kind of forced maybe the administration to rethink about things. And obviously, like I said, you're going to go in the election, and U.S. consumers vote with their wallet, and they're not going to tolerate, I think, empty shelves. So I think there's a plan from the administration, but I think there's a short window. So we're going to be open-minded at not get too negative and say, well, I'm going to go buy a bunch of utilities or a bunch of safe stocks that don't compound capital really fast over time, or a bunch of better companies, they're down, the market's down 20, they're down 30, 35, 40, 50. And that's what I want to focus on. So I'll give you a real-life Canadian example. I can't tell you, obviously, what I did with a stock, but so exactly 3 weeks ago, on Thursday, post-Liberation Day, one Canadian stock I'm a Canadian portfolio manager that we want to be focused on is Aritzia. So Aritzia is obviously affected by tariffs. A lot of production's out of Vietnam. So, we do our best estimate that if the company takes no action, how much earnings are going to be down by. And our estimate was down 40%. And then that day we spoke to the company, and they're not gonna confirm or unconfirm our number, but they can help us work through our assumptions. So we think if they don't do anything, earnings are gonna be down 40%. And if the Vietnam tariffs don't go away. Now the stock's down 20, it's not down 40, right? The markets are pretty efficient. And that's the world we live in. We have to decide, okay, well, the spreadsheet's telling you 40. The company can probably do things. The stock's down 20. There's a lot of volume. The stock's down from $70 to $40. There might be a recession, but they're also growing into the United States. So what do we do? And that's what we're left with all the time in these kind of situations. And I think that's where experience really, really comes in. And, you can choose to sell the stock if you think it's going to be a disaster. But, I was going into those meetings with a lot more, maybe it's an opportunity for a portfolio manager like me. And you got to make those decisions with imperfect information all the time. And these are the kind of situation we deal with. So there's kind of a, macro, broader view, how you're thinking about it as a PM, the experience you have. And then there's going into the micro with the team and thinking, okay, what are the numbers saying? What's our best educated guess? And that's how we deal with it.
Well, you've learned a lot since 2002, and you're going to continue to learn more. And it's wonderful that you're in an environment where you all learn from one another and challenge one another as portfolio managers and analysts as well. Last time I looked at the top 10 for Greater Canada, the number one holding, I believe, was Westinghouse Airbrake Technologies. I remember Connor Gordon talking about that stock from a small cap standpoint in the US. That leads me to believe that you can go across capitalizations. So not only can you take the remainder, the percentage outside of Canada and go global, but you can also change capitalizations. Can you talk about that as far as small, mid, and large for your portfolio?
Yeah, Greater Canada is really kind of an omnivore fund. I can kind of do it all. I mean, I can't do like super micro cap, but we kind of like. I know you can drive a truck through what I'm going to say, but you can. These two to 100 billion, 2 to 20, 30, 40 billion dollar. They're real businesses, and Wabtec, which is a short name for Westinghouse Airbrake, kind of fits right into that. So, it's a good business. It's kind of the only play in town for a next generation locomotives. There's aftermarket parts. The multiple's not excessive. There's margin opportunity. And that's an example of a stock, right? It gets caught with everything else, it goes down, and they just reported, and the numbers are fine, and the company's doing a good job. They've made a couple of tuck-in acquisitions. So, I think there's a lot of opportunities like that. That's why, some other PMs that are more like, I'm going to own this or this country, and I'm more like, me personally, just want to own like really good businesses, and especially when things get spicy, like 3 weeks ago, I think it's we know what our good businesses are. and and there's an opportunity because they're down, and it's I think it's never ending in our business. Stock's $100. People, the analysts will tell you, oh, it's 100, but I wish it was at 80. I would really like it at 80. And then it's 60 and they hate it because, well, it sounds worse. Well, of course it sounds worse. Like, it went from 100 to 60, not because it sounds better, it sounds worse. But maybe there's an opportunity that they have the balance sheet to survive through these moments. Management's good, we can trust them. It's a good business, and it's cheaper than it is on EV to sales or some other metrics. And those kind of the moments that I live for.
You also live for talking to the analysts about fundamental research all the time, and you're pouring through those research reports, like you said at the outset of this video. Fidelity also has technical research and quantitative research. Do you ever tie into either of those?
A little bit, but...
It's there if you need it.
Well, yeah, I mean, I've learned the hard way that, maybe you want to buy charts that are going up instead of going down, but you get to the point where, I think, let me re-explain that a different way. I think generally we over-stress out about valuation, and I think, technicals can help there. I do truly believe that valuation matters at extremes, and I think, and we were kind of there. I kind of want to emphasize that. Like 3 weeks ago, on some of the companies that were already not doing well, they took another leg down post-Liberation Day. If you look at long-term charts, and you can't really look at earnings because the earnings are low, so the P will look high. But if you look at price to book, for example, and if you look at EV to sales, I can name you quite a few companies that were kind of there. There are 10-year lows, at 15-year lows, there are all-time lows. So if you don't buy them then, when will you buy them? So, I'm all for technical analysis in between. But, at extremes, I truly believe in, anchoring to history, anchoring to future earnings, anchoring to our best businesses, and I think that drives my process.
You talked earlier about not being focused on gold, but could you talk about risk management? You are a Lipper Award winner, which really has to do with risk-adjusted returns, which is important for the investor. How do you manage risk in your portfolio, in particular in this environment?
Well, the best risk manager is owning a bunch of really quality businesses that don't have balance sheet risk. And you think about gold, for example, right? There's absolute risk and there's relative risk. And, we're paid on a relative risk basis. But, gold's a big sector in Canada. And I talked about it a year ago at Beverly Hills, right? I talked about commodities and I had increased my commodity exposure. And I ranked them in order, copper, gold, and oil, energy. And it's really been all gold, right? And central banks are diversifying their U.S. dollar position. When U.S. Treasury yields were going up, U.S. dollar was going down. That's good for gold. It's the anti-U.S. dollar play. But I think it took a kind of a narrative of its own a little bit, and it was a little bit overbought. So the point I'm trying to make is that's one way to manage risks is not chase what other people are buying. And look, they're tough businesses. I covered them, except for the royalties. And even the royalties, sometimes you can have negative surprises. They're really tough businesses. And you're seeing it today. There's pretty big gold stock that's down double digit because they're facing cost inflation in the quarter. So when things get tough, I don't want to chase the worst businesses. And I would include gold generally into that. And you really want to pick away at your best businesses that are down and out. And I mean, I know I'm repeating myself, but it's just a lot of people don't do that, right? And someone asked Napoleon once, what makes the different definition of a great general? And Napoleon replied, the one that can do the ordinary in extraordinary times, or the person that can just do their job when everybody else is losing their minds. And I really like that quote because I think it illustrates a lot what I've tried to do as a portfolio manager. 2003 was a really good year for me coming out of the 2002 recession as an analyst. 2009 was a really good year for me. 2020 was a really good year for me. Like every time we get these major bear markets, dislocation, a lot of people end up just throwing whatever playbook they have and hide into safety. And I'm always kind of been wired a little bit the opposite. I don't think I do anything extraordinary. It's just like, what are our favorite names? What are the stocks that we always want to buy? And that's really important right now. Like I probably own 4 or 5 names in Greater Canada that I've never owned before, or at least not in size. Because that's a great time to buy good businesses that I never bought because, the market's pretty efficient. So maybe they were like 30 times earnings and now they're down 30, 40% because there's cyclical risk. And that's what I try to do in those moments.
So as a contrarian investor, you're there when others are running, which is...
Well, I try to be. It's not always perfect, but I try to.
But I remember our discussion in Beverly Hills last May, I believe it was, and you were focused on commodities, but you can change, you can be nimble, and that's what active management, you're the definition of active management, which is great. And hey, you're optimistic. What sectors or what themes are you seeing as opportunities right now?
So, there's a lot of things going on. On the European side, we're looking, Germany's going to stimulate. Can we buy some, good, unique European businesses tied to, the stimulus of the German economy? I've been underweight tech for like 2 years because there's nothing really contrarian in it. I can tell you that I've bought some tech stocks over the last month or so. There were some names that were really down and out. Some of them are reporting, decent numbers right now. That's one thing, an area that I've been focused on. Less so the AI pick and shovels, but other type of businesses that we like. It's just, there was really nothing contrarian about them, and maybe some ad tech businesses. And the world kind of freaked out, and maybe that's an opportunity. Probably the eye of the storm right now is consumer, like retail stocks, right? They're obviously in the eye of the storm for tariffs, probably recession. So I want to be prudent, but that's definitely one area that I want to focus on. There's really good quality businesses in travel. We all know, Canadians are not traveling to the US or less so. So that's, the market sniffed that out. It's crushed some high quality travel stocks. Is that an opportunity? Anything that's consumer, like I said, tariff related, but you got to watch the balance sheets. And then on the US side, I would also put, some of the hard cyclicals. They really took a leg down on this recession, early cycle, cyclical, transportation. Is there some opportunity there? Like, I think some of the names are like 10 times recovery earnings. So that's interesting. So I gave you a lot there. What I'm not interested in, like I said, or less interested in is safety. Gold, staples, Utes, some of the healthcare stuff. Whatever is not too cyclical, I'm not that interested in. And incrementally, I'm more interested in, can we find some businesses that can really kind of, and one great way to do it is you look at stocks that have been great stocks over the long run, right? And then you look at them like in the short term, things have been tough, and then you do like long-term valuation, balance sheet analysis. And that's one area I'm focused on.
So if I can unpack some of the theme of what you were just talking about, if it was about consumer, travel, even AI, because you're focused on technology, but not so much AI, you're looking at areas that may have been overdone or may have concern around them, where an investor is extrapolating a concern today and saying it's never going to recover, like we heard during COVID, and you're seeing opportunity there because of great valuations, correct?
Yeah, yeah, exactly. It's not as extreme as COVID, but we know what the good business models are. These asset-light, quality businesses, and I'll give you an example for the past, right? Because it's really hard for me to talk about current examples, but we've always been a fan of Franco-Nevada. It's a superior business within the gold metal space. When Cobre Panama shut down, right, which was I think over 20% of NAV or 20% of cash flow, something like that, right? Franco-Nevada got really dinged and hurt, but it's a superior business model, and it became the biggest bet in ops and a pretty big bet in Greater Canada. And now gold's done really well, and maybe Cobre Panama can reopen eventually, and the stock's done well. So I kind of want to take you back to that moment, or late 2022, where Meta's in the hole because of the metaverse investment and TikTok potentially, and or Amazon's not doing well, and you kind of take those learnings and you kind of apply today. Today the pain is, U.S. economy, U.S. cyclicals, early cycle stocks, and they sound terrible, and you want to be a little careful with your weights, but that's kind of where I want to be thinking about. And the stocks are up and to the right. You leave that to others, and we've had the dispersion, I think, in European defense stocks. So that was a bet, and I don't own those stocks anymore. And you want to leave that to others, and that's fine. And you want to focus on what's not. I can't name them, but there's so many stocks that the S&P fell 19%, 19.5%, and a bunch of names that everybody liked 4 months ago were down 35, 40, and that's what I want to focus on.
So Hugo, you're active, you're nimble, you're able to look at cross capitalizations, you're able to look around the world, and you're able to go places that other people are running from, and you're looking at opportunity in this environment, which is a real positive. You should be mixed in with Dan Dupont and Mark Schmale in something like Global Equity Plus, and you are. Could you talk briefly about Global Equity Plus, please?
Yeah, I'm lucky to be mixed in with these guys. Look, Global Equity Plus is doing what it's supposed to do, right? So, if we would have spoken at Vision 2, right? I think it was in October, was it? So how many months is that ago? Like 7, 8? It was all Mark, right? Mark had a career year last year. He really did. And we're very lucky to have him on the team and offer to Canadian clients. He's a unique talent. And look what has happened year to date. It's been a lot of Dan. Dan's doing well. It's been more his market. Chinese securities, Japanese banks, Europe, defense staples. So, and hopefully it's going to be my cycle at some point too, right? I want to be the star in that product for 6 months that people talk about me. Hasn't been the case. It's been a very humbling year. But I think that's why the Global Equity Plus exists, is, to give you that mix, because it's really hard to predict what's going to do better over the next, 6 months, year, or 2 years. And just having a third all the time, right? A little bit of each and every one of us. I'm just looking forward to the day, frankly, Glenn, when I'm the one pulling the fund up. So I can't wait for that to happen. But, we're working with very different individuals. And what's the most important is to keep our clients in the game, right? I just can't say that enough. You got to stay in the game. And, I personally own my 3 funds. That's all I own. I don't trade stocks. But I think for clients and our clients as clients, that there's a tendency to go out at the wrong time and into the other thing, to just, stay into a product that will compound capital over time. I think that's what Global Equity Plus exists.
Thank you for that, and thank you for being a guiding light in these times of volatility. We appreciate your comments and learned a lot today. Thank you, Hugo Lavallée.
Thank you, everybody.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.